Hey, what's up, everybody? It's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome to 1 Minute Monday. I've been in the industry for over 20 years now, and my job is to help you understand not just what's happening with mortgage rates, but why it's actually happening and how you can make smarter decisions because of that. Now, from there, we work together to uncover what's most important to you so that we can build the right mortgage strategy without you needing a translator. So each week, I actually take the complexities of the market and I break it down in a way that fits how you consume it best. So if you're somebody who just doesn't have time to learn about Fibonacci retracement or Japanese candlesticks and you just want to know what time it is, I got you. The first minute or so here, it's just for you. But if you want to understand how the clock actually works, stick around just a little bit longer. And if you want to know how to build the clock, hang in here with me because this week is a really interesting one. All right, if you just want to know what time it is, here's what you need to know right now. Mortgage rates are actually improving slightly this week after a really volatile week last week. And according to Mortgage News Daily, the national average at the end of last week was 6.55 for the 30-year fixed rate. It was 6.12 for the 15-year. The 30-year FHA was 5.98 and the 30-year VA was 6%. Now remember, everybody, these are national averages. Your personal rate's going to depend on your credit, your down payment, the loan type, the loan size, and a whole lot of other stuff. So if you want help learning what you actually qualify for or how to optimize your application to get the best possible rate, make sure you reach out. Now, here's the big story of the week. The job market's actually slowing. Consumers are getting kind of nervous, and because of that, the market's now leaning back towards rate cuts, not rate hikes. Now, we actually saw fear of a rate hike spike briefly last week, but after a really weak consumer sentiment report, those odds dropped pretty darn fast. And right now, the bond market's saying we may not be overheating, we might actually be slowing. And when the economy slows, mortgage rates tend to improve. So here's your key takeaway. We've moved back into kind of a floating environment, but only if you've got a loan officer who understands the market and can move quickly when things shift, because this market, man, it can change fast, and we're not out of the woods yet. Now, with the volatility that we've seen this year, it's more important than ever to work with a certified mortgage advisor who actually helps you win with strategy, not guesswork. And yes, we're officially back in the range where refinance conversations may actually start to make sense again for some people. Now, if you just want to know what time it is, your work here is done. But before you go, I hope I can count on you to like and subscribe and share this information with somebody who just needs some good, honest advice. All right, now let's go ahead and talk about what's actually driving all of this. There are three major forces right now that are kind of hitting mortgage rates. The labor market's slowing. The ADP report actually showed only 40,000 jobs added over the last month, and that's pretty darn weak. Now, on top of that, we've actually seen job losses in prior government data, and continuing claims they're actually staying elevated. It's getting harder for people to find jobs, and when employment weakens, the Fed starts thinking about cutting rates. Now, consumers are also getting nervous. The University of Michigan Sentiment Index actually dropped from 57 to 52. Now, this is a monthly survey that measures how confident people feel about the economy, their finances, and job stability. And when people feel uncertain, they spend less. And when spending slows, the economy slows. Now, here's the kicker. 61% of people think unemployment's going to actually go up, and only 13% think it's going to go down. That kind of a gap? Well, you typically don't see that unless you're heading towards recessionary territory. And then we've got oil and geopolitics, rising tension around Iran and the Strait of Hormuz. Higher oil prices create inflation in the short term, but they also slow the economy because people spend more on gas and less on everything else. So over time, that actually becomes deflationary. So the market's kind of asking this, is this inflation or is it the beginning of a slowdown? And right now, the bond market, it's actually leaning towards slowdown. And this is a big week for economic data. So here's what I'm actually watching and how it could impact rates. On Tuesday, we get job openings data, or JOLTS. And if job openings are dropping, that's a sign the labor market's cooling, which is typically good for mortgage rates. Now, also Tuesday, we get home price data from Case-Shiller and FHFA. Now, if home prices are still rising, that can keep inflation pressure in the system, which is slightly negative for rates. Now, if they flatten or decline, that could be helpful for rates. On Wednesday, we get the ADP employment report. Now, if it comes in weak, that supports the slowdown narrative, which will be good for mortgage rates. If it comes in strong, rates could move up quickly. Now, we also get retail sales on Wednesday, and if spending slows, that's going to be good for rates. If it's strong, then that can actually push rates higher again. On Thursday, we're going to get jobless claims, and if those claims rise, that's more evidence of a weakening labor market, which is also supportive of lower mortgage rates. And then on Friday, it's the big one, the government jobs report, non-farm payrolls, and unemployment. Now, here's the important part. The market's actually closed for Good Friday, so when that data comes out Friday morning, there's not going to be any kind of live reaction. That means that whatever happens in that report, it's going to actually get pushed into Monday. And that can lead to bigger moves when the market actually reopens. So going into the end of the week, just be aware of that timing. So this week, it's all about the labor market, because right now, that's the biggest driver of where mortgage rates are going to go next. And this is where most people get it wrong. They think bad news is bad for rates. But in reality, bad economic news, it's often good for mortgage rates because it pushes the Fed towards cutting the Fed funds rate. Now, let's go ahead and build the clock. This is where you separate yourself from 95% of people that are yapping about rates, because not all rate improvements are created equal. There's two different reasons rates fall. The good version is when inflation's actually cooling, the economy's stable, jobs are strong, and the Fed can ease rates naturally. That's the environment everybody wants. People are still working, income is stable, confidence is high, and borrowing becomes a lot more affordable. That's a healthy market. Now, the other version is when rates fall because the economy's slowing down or heading towards a recession. Business slows down, hiring freezes, layoffs increase, consumer spending drops, and the Fed cuts rates not because things are going well, but because they're actually trying to fix something. And this is the key. We may be shifting from inflation-driven rates to recession-driven rates. And if that's true, that changes how you should think about buying or refinancing. Now, most people think rates are dropping, I should wait. But the real question is, why are they dropping? Because if rates are dropping due to a weakened economy, job security generally matters more than rate timing. A solid plan matters more than chasing the lowest interest rate, and being pre-approved the right way becomes crucial. Lower rates don't help if your income becomes uncertain. That's why strategy beats timing every single time. So what should you be doing right now? Well, if you're a buyer, get fully underwritten, not just pre-qualified. Understand your real payment comfort zone. Yeah, it may be necessary to cut out a dinner or two out each month so that you can afford the home that you love while we're waiting for rates to come down so you can have that refinance opportunity. But build a plan, not just a guess. If you're already a homeowner, review your current rate versus whatever the opportunity is. Don't wait for the perfect moment. Look for windows, not headlines. And if you need help with this plan, we're always here for you. Now, for those of you who like the technical side of things, here's where the markets, or what the market's telling us. Mortgage bonds have pushed back above the 99.99 level, which is a positive signal. Now, there's room to improve upward all the way to the 100.46 resistance level, and that tells us that rates could continue improving if momentum actually holds. Now, on the Treasury side, the 10-year Treasury yield, it's trying to break below a key trend line with room down towards the 4.33 support level. And if that happens, that would typically support lower mortgage rates. The bottom line here is that the technicals are leaning slightly favorable, but this is still a volatile, headline-driven market. So to start the week, floating does make sense, but you need to stay close to the market and close to your loan officer. Nobody has a crystal ball, at least not one that's actually working right now. But what we can do is read the signals. And right now, the signals are shifting from an inflation fight to a potential economic slowdown. Now, if you're thinking about buying, refinancing, or you just want help with that strategy, make sure you reach out. No pressure, no sales pitch. Just a conversation. We're never going to bug you to do stuff before you're ready. We just want to make sure that we're there for you how you need us whenever you are. And as always, thank you so much for watching. Thank you for supporting the Home Foundation, which helps make our heroes' homes more affordable and shines light on local charities that support them. Happy Monday, everybody, and we'll see you next week.